Now, as an owner of a business, whether it's a sole trader or a partnership, you are going to be interested in what you're earning out of that business. You've invested capital into the business, and for that you're wanting to get a return. You're wanting something back for it. If you had put it into the bank, for example, you would be earning interest. So what we're saying is, if I put 10,000 Rand into a bank, into an investment, and at the end of the year I earn interest of 1,000, and you found a percentage of that, you would find that you're earning 10% interest. So you had to put money in and you got money out, and we're converting it to a percentage. Now, if you looked at the sole trader, remember, the owner would have put capital in and he would have got a net profit out. Now, that net profit is being made over the whole period of time. So if your capital, let's say, was 20,000 at the beginning, but it's 30,000 by the end of the year, you've actually obviously increased the capital. But on top of that, this profit, although we only calculated at the end of the year, has been earned throughout this year. And so when there's an earning going on throughout the year, we get an average of our capital. So let's say, for example, that in this business, I actually earned 5,000. My average capital, now when you're doing average, 20 plus 30, so add the 2, divide by 2 would be 25,000. And you times by 100 over 1, and in that case there you would be earning 20%. Much better than our example here. Now, you would have done that last year in grade 10. Now, this year you are looking at a partnership. Now, the first thing to remember is the business makes a net profit. So that net profit is earned by all the partners. So the net profit has to be put over the money the partners put in. But what you've got to watch in a partnership is they didn't only put capital in, they also have money invested in a current account. And exactly the same way as I said over here, you have to get an average because the profit would have been earned throughout the year. If you look at individual partners, that net profit, however, was shared out. And it was shared out in the form of a salary, the interest on capital, they might get a bonus, and their final share. Now that is what the partner is getting out. And he put in, he's got capital plus a current account, and you have to find an average. And if you're doing it just with that of partner A, you just work at his average and then do the same for the other partners. Or if you're doing it for the business as a whole, then it's all of their earnings at the top over all of their capital and current accounts here. Now, if we have a look at this exercise, the net profit here was 152,000. That was divided out by paying salaries and interest and the remaining profit. Now, the first thing that I want to do is they ask you over here to work out the percentage return earned by the business. It's the whole business. So what you're going to do is say, right, that net profit that I earned, 152,250, that's the return, which would add up to all of these, the salaries, the interest, and the bonuses, and the final share of the profit. But what did the owners put in? They put in capital. There's Naidu's and Martin's. There's a current account, and both of these are credit, so they're pluses. If you got a debit, you'd have to minus. So this calculation is quite a long calculation. If you look here, there's your net profit. So you're going to have to take the capital of Naidu, beginning and end, the capital of Martin, beginning and end, the current account of Naidu, beginning and end, and the same then with Martin. And you'd have to add all of that up and divide by 2. The reason why we're still only dividing by 2 is we want an average from the beginning and the end of the year. And so add all that up, divide, and then you get that 763. That is the average capital that's in this business for both partners. And if you solve it, they're getting a return of 20%. Now, if they asked you to work out Naidu earned a salary, he earned interest, and he earned a share of the profit. So of the total profit up here, he earned 94,500. His capital beginning and end, his current account beginning and end, and divided by 2 to get an average. And in this case, he would be getting a return of 23.4%. And then you would do the same with Martin. Now, in order to comment on this, remember you could have put money into an investment. And at the moment, investments are running at about 7 to 8%. And they do change, so you're going to have to be aware of that. But if you work on an average of 7 to 8, that's fine. You need to compare this. The business is earning 20%. So the business is earning far more than they could if that money was in the bank. And that's good. Naidu would also be happy, because if he put his money into the bank, he would only have earned 7-8%. He's earning 23%. So that is good. And then obviously you would work out Martin. If that is a 20%, it's obviously got to be in between. And all you know, and you can calculate this, is that Martin is going to be lower than 20. But it'll still be above the current interest rates. And then you would also have to look over here, back in the textbook, and last year they told you the business earned 18%. This year we've just calculated they're earning 20%. So not only has there been an improvement, you also the business is earning far more than the alternative investments. As I've only shown you Naidu's, just look at Naidu. Naidu earned 21% last year. He's earning 23.4%. So your comment is going to be it's actually increased, and you must state the figures. It increased from 21 to 23.4, and that is a lot more than you can get in alternative investments, and you quote 7 to 8%, and so therefore they should be happy.